It's the BiggerPockets. My name's Fragale, and today we're talking about something that I get asked about all the time, and that is real estate syndication and private equity real estate funds. Let's get an intro going. Okay, just when you thought we couldn't get any nerdier here at the BiggerPockets, I'm literally I'm literally pulling out the textbook for this one. This is actually a great textbook for people in school. I'm not saying to go buy a textbook on Amazon right now, but the textbook Real Estate Finance and Investments is written by a professor named Peter Linneman, and he's actually one of the authorities on real estate finance. And he basically wrote the book on this stuff. That work? Yeah. Sometimes people get confused as to the difference between a real estate syndication and a private equity real estate fund. And today, I'm gonna try to break that down for you. They're both used for the same purpose, trying to acquire assets of all different shapes and sizes: industrial, office, multifamily. It's basically pooling of capital to purchase these assets. The inception of private equity real estate funds was really a product of the 1980s. Some of the major players are groups like Blackstone, Apollo, the Carlyle Group. These companies raise capital and raise these funds to purchase real estate. Now, one of the major differences between private equity and real estate syndication is private equity is, as Dr. Linneman says, a trust me vehicle. It's basically a blind pool of money that is raised by what's known as the general partner. Now, the general partner, or the sponsor, or the manager, there are various names for that position, is a fiduciary to what's called the limited partners. So very simply, if I'm in the general partner, I have 10 limited partners, I am running the fund for those 10 limited partners. Now, when it comes to private equity, that fund is typically pre-raised. So that is a fund that's raised well in advance. Oftentimes it could take years to raise the capital for a certain fund. But once that fund is raised, the capital is now deployable, which means that that manager is basically on the hunt for investments that fit the investment philosophy of that fund. And speaking of investment philosophy, in a private equity real estate fund, that's what you're buying into. You're buying into me as a GP. Oftentimes when general partners are raising money, they are raising money and they are going, as Linneman says, in a trust me vehicle. They're basically telling the LPs, look at us, look at the things we've done in our life, look at the capital we've raised, look at the fancy schools we've gone to. And what you're buying into is an investment philosophy. And that could be, we buy industrial properties in the Midwest, and this is the one thing we do that nobody else does in a certain way that we do it. And what they do is they're asking for a blank check. They're asking for you to capitalize them so that they can go out and look for these properties. Conversely, in real estate syndication, it's oftentimes that it's asset specific. You will still have a general partner and limited partners, but in this case, the general partner will typically not raise capital, that is actually be capitalized, cash in the bank, until a deal is tied up. And that's not to say that general partners don't prudently pre-raise money. They'll go out to limited partners or potential limited partners and talk to them about how much they would be willing to invest if this type of property came around. So oftentimes they'll have a pitch deck with an outline of the properties that they're looking for, and they'll ask potential limited partners, if this comes around, would you be interested in investing? But there's no guarantees from the limited partners. And once the general partner in a syndication has the deal under contract, that's when the clock starts ticking. He or she has got to start raising some capital. So real estate private equity fund, typically a blind pool, but the money is there. If there is a transaction that they want to make, they know that they can complete that transaction in a timely manner. On the flip side, real estate syndication, you're talking about an asset-specific situation that you tie up a property and you basically have to raise the money for that property specifically. That can be challenging, and there are a lot of great syndicators out there. So, there are different investment strategies that they can use to make sure that when they do tie up those properties, that they can actually raise the funds. A little bit of a legal disclaimer here. There are certain laws that come into play when you do raise capital in the form of a real estate syndication, because it's considered an instrument. And once anything is considered a financial instrument, the SEC comes in. Oftentimes you'll need what are accredited investors or sophisticated investors. But that's lawyer talk. Right now, we're just talking about the broad strokes. All right, let's talk compensation. So for both private equity and real estate syndication, there's a number of ways that the general partner can get paid. I like to break it up into two different areas of compensation for the general partner. There is the actual management of the fund or the real estate syndication, and then there's the upside. And the upside is broken down further into two different sections. There is the disposition, the selling of an asset, and how that split works between the general partner and the limited partner. And then there's the actual cash flow of the property. And oftentimes, the general partner, the one running the operation, will not get paid their proportionate share or an agreed upon proportion until they meet a certain threshold for their limited partners. For instance, if I was a general partner in a syndication and I told my limited partners that I would pay them, or the deal would pay them 8%, what's called the preferred term, a year, and I wouldn't take a penny of it until we met that 8%. However, above and beyond that 8%, I would split it 50-50 with the limited partners. This is just an example, but it just goes to show you the actual upside can be actually disproportionate to what I initially invested. Oftentimes, the general partner will put in 5%, 10%, maybe 15% of the actual deal, and they could have a disproportionate upside once a threshold has been met. For instance, 20%, 40%, maybe even 50%. What we're seeing more on the private equity side too is that we're seeing a lot of consolidations. We're seeing these big brand names, and that's really what it comes down to when it's a private equity fund. It really is the brand name. Trust me with your capital. This is our investment philosophy. This is what we do. But that being said, I don't think real estate syndications are going anywhere. They've been around forever. Oftentimes, they're one of the best ways to raise capital. You have a manager who's the operator, who's dealing with the day-to-day operations. And then you have your limited partners who are getting compensated on a passive basis. So again, on the compensation front, we're looking at the general manager getting paid on acquisition, disposition, asset management, which just means they're managing the manager in the case of a syndication, or the fund in the case of private equity real estate. So these are all the different ways that a general partner can get paid. And on the flip side, the limited partners, they're limited in their liability. They can only lose the money they've invested, and they get the passive, hopefully, cash flow of the business, the property. And then finally, on disposition, there's potentially quite a bit of upside to be made. All right, that's it for me. If you have any questions in regard to real estate syndication, private equity funds, leave a comment below. If you have any suggestions for videos, same thing. Hit the like bell, subscribe. My name is Fragale. It's been a slice. Till next time.